Welcome to another episode of Market Brief After Hours. We have a highly packed show for you today as we unpacked a very busy session across global markets. From a relief rally on Wall Street to some pretty dramatic shifts in bond yields, commodities, and escalating trade tensions, there is a lot of ground to cover. Let's start with the big picture. What was the primary driving force behind the positive action on Wall Street today?
It really came down to a much-needed breather in the bond market. We saw Treasury yields retreat for a second straight day, which gave equities, especially technology and growth stocks, some room to run. The S&P 500 rose slightly, gaining 0.32% to close at 7,677. The Nasdaq Composite led the gains, advancing 0.66% to end at 26,151, heavily supported by a nice bounce in semiconductor stocks. Meanwhile, the Dow Jones Industrial Average managed to notch its third straight winning session, gaining 160 points, or 0.3%, to close at 53,577.
That retreat in Treasury yields seems to have really calmed investor nerves. What exactly triggered that downward move in borrowing costs?
A couple of things are at play here. First, there's been a lot of focus on how the Treasury Department plans to fund its ramped-up bond repurchases. Reports surfaced that the Treasury could use its near $1 trillion general account to pay for these buybacks. That prospect really helped pull yields down. The benchmark 10-year Treasury yield fell more than 7 basis points to 4.625% and was seen around 4.629% later in the session. Meanwhile, the longer-dated 30-year Treasury bond yield fell more than 6 basis points to 5.163%, and the policy-sensitive 2-year yield shed over 5 basis points to sit at 4.183%.
While tech and broader indices had a decent day, the retail sector took a massive hit. Can you walk us through what happened there?
It was a brutal day for retail, highlighted by Dick's Sporting Goods. Their shares plummeted a staggering 30% after posting disappointing results, marking their worst single day on record. That drag spilled over to other major retail players, with Target falling nearly 4% and Walmart down 1%. It seems like we are seeing a real divergence in the market right now. On one hand, tech is flying high, especially chip makers. Nvidia snapped a 7-day losing streak, rising 2% ahead of its highly anticipated earnings. AMD gained 5%, and Micron was up 3%. On the other hand, traditional retail is feeling some serious pressure, which aligns with some of the weaker economic data we saw today.
That retail pressure definitely connects to the latest consumer and housing data. What did those reports show us?
The data paints a picture of an increasingly cautious consumer. The Conference Board's Consumer Confidence Index dropped to 89.4 in August, down from 90.2 in July. Economists were expecting it to hold steady at 90.2. What's interesting is that while consumers' view of current business and labor conditions actually rose by 6.8 points to 121.2, their expectations for the short-term future plummeted by 5.8 points to 68.2. People are getting increasingly anxious about the road ahead.
And we saw some soft housing numbers as well, which might feed into that anxiety.
Yes, new home sales for July tumbled to 607,000, down from 678,000 in June, coming in below the consensus estimate of 615,000. Interestingly, the median sales price of new houses fell 2.3% month-over-month to $393,800. Now, if we look at the S&P Case-Shiller 20-City Home Price Index, nominal prices actually rose 2.1% year-over-year in June. But here's the catch. When you adjust for inflation, real home prices actually fell for the 13th consecutive month because inflation is still outstripping nominal price growth.
These are incredibly fascinating dynamics. We are going to take a quick break, but when we return, we will look at the escalating trade tensions between the U.S. and Canada, the geopolitical ripples in Asia, and run through the latest moves in the currency and commodity markets. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were analyzing the U.S. consumer and the housing market, but we also have some major international developments to discuss, starting with some significant moves from our neighbors to the north. Canada made a pretty bold trade announcement today. What's the story there?
Canada announced retaliatory tariffs against the United States, matching the 50% levies that President Trump imposed over the weekend, dollar for dollar. This escalating trade conflict is definitely weighing on broader market sentiment. And that's not the only geopolitical friction investors are watching. Beijing has warned the U.S. that it will retaliate if Chinese companies are included in any significant expansion of secondary sanctions relating to Iran. These sanctions currently target entities in Hong Kong and mainland China, but have avoided major Chinese financial institutions so far. Since China buys 90% of Iran's oil, any further escalation could seriously disrupt the relationship, right before the scheduled meeting between the two presidents in Washington.
How did global equity markets react to all of this geopolitical noise?
Surprisingly, European stocks closed mostly higher, helped by falling energy prices and a slight easing of fears over the Middle East conflict. The Pan-European Stoxx 600 rose 0.35%. Germany's DAX led the major indices, up 0.61%, boosted by German business confidence rising to 88.8 in August, its highest level since August 2025. Germany's Q2 GDP was also revised upward to 0.3% growth. Meanwhile, the UK's FTSE 100 gained 0.29%, and Switzerland's SMI climbed 0.54%, though France's CAC 40 bucked the trend, closing down 0.16%, as French consumer confidence remained flat at 86. We also saw Spanish producer price inflation accelerate sharply to 9.2% in July, up from 7% in June, driven by a 20.8% surge in energy prices. And how did the Asian and Pacific markets fare?
It was a mixed bag, but generally positive. Japan's Nikkei 225 rose 0.58%, and South Korea's KOSPI climbed 0.68%, despite South Korean consumer sentiment slipping slightly. China's Shanghai Composite added 0.19%, while Hong Kong's Hang Seng dipped a mere 0.02%. Down under, Australia's S&P ASX 200 had its best day in nearly 3 weeks, rising 0.7% ahead of their inflation report, and New Zealand's market advanced 0.8%, led by consumer staples like A2 milk, which surged 5% as traders reassessed its earnings. Taiwan's TAIEX also had a strong showing, up 0.91%, while Singapore's STI gained 0.71%.
Let's transition to commodities, where we saw some massive moves today. Oil took a pretty big hit, didn't it?
It did. Crude oil prices tumbled over 3%. West Texas Intermediate crude fell 3.1%, 36 cents a barrel, while Brent futures dropped 3.9% to close at $88.58. This slide is largely due to the U.S. shifting its strategy toward economic pressure on Iran rather than military escalation, which calmed fears of a wider conflict in the Persian Gulf.
On the flip side, gold is continuing its historic, almost vertical run.
Gold is absolutely relentless. It closed up 0.35% at $4,666 an ounce, trading as high as $4,697 during the session. To give you an idea of how stretched this move is, gold is trading significantly above its key moving averages. Its 50-day moving average is all the way down at $4,192, the 100-day is at $4,390, and the 200-day is at $4,508. While the structural trend is incredibly bullish, this parabolic advance might eventually invite some healthy consolidation.
Let's dive into the foreign exchange market now. We've seen some key technical developments in several major currency pairs. Let's walk through them, starting with the euro.
The Euro-USD extended its recovery, closing up 0.11% at 1.1676. Technically, it's looking very constructive, trading above all its major moving averages. The 50-day moving average is at 1.1477, the 100-day is at 1.1574, and the 200-day sits at 1.1630. Holding above that 200-day moving average keeps the near-term bias tilted to the upside, with eyes on the 1.1700 psychological level.
What about the British pound? It seems to be on quite a run.
Yes, GBP USD is showing very strong upward momentum. It closed at its absolute session high of 1.3653, up 0.16%. It is trading well above its clustered moving averages. The 50-day is at 1.3403, the 100-day is at 1.3439, and the 200-day is at 1.3428. This clean breakout suggests the bulls are firmly in control, and we could see further upside toward 1.3700.
And the Aussie dollar?
AUD USD rose 0.23% to close at 0.7165, pressing right into a major overhead resistance zone. It remains comfortably above its 50-day moving average of 0.7001, its 100-day of 0.7072, and its 200-day of 0.6955. If it can clear 0.7165 on a daily close, it opens the door for a run towards 0.7200.
How are the cross rates looking, like the Kiwi against the yen?
NZD JPY had a strong session, surging 0.36% to close at 95.14, right near its session high of 95.15. It's trading well above its key moving averages. The 50-day is at 93.38, the 100-day is at 93.41, and the 200-day is at 92.46. It's staging a sharp V-shaped recovery and is now testing major structural resistance near 95.50.
Finally, the Canadian dollar seems to be strengthening against the greenback.
Yes, USD CAD drifted lower, closing down 0.10% at 1.3830. Crucially, it slipped below its 200-day moving average of 1.3844. It was already trading well below its 50-day average of 1.4055 and 100-day average of 1.3912. This breakdown below the 200-day moving average really reinforces the bearish structure we've seen since the late June peak, and we could see further downside 3,800.
Let's wrap up with some of the individual corporate stories that caught your eye today. Who were the major market movers?
There were some massive moves. Moderna was a standout, surging over 14% to lead the S&P 500 gainers after an upgrade from Wolfe Research. We also saw a big rally in crypto-exposed stocks as Bitcoin hit a 3.5-month high. Galaxy Digital Holdings jumped over 8%, while Mara Holdings and Riot Platforms both gained more than 6%. Robinhood was also up about 8% on that crypto optimism and strong retail prediction market volumes.
And on the flip side?
Bath & Body Works dropped 8% ahead of its earnings release tomorrow. Target, as we mentioned, fell over 3%, partly due to a public relations issue over removing a controversial Halloween costume. And on the positive side, for capital raises, Madison Air Solutions jumped more than 12% after announcing a massive $2.25 billion private placement of its common stock.
An incredibly busy day across all asset classes. As we look ahead, all eyes will be on tomorrow's GDP and PCE inflation reports, leading up to Federal Reserve Chair Kevin Warsh's speech at Jackson Hole on Friday. That will be the key catalyst to watch. Well, that is all for today's episode. If you find this useful, please follow Market Brief After Hours. We will see you next time.